So, how do we participate in the forex market? There are actually two ways. The first one is through physical trading. And through physical trading, this is something that you guys have already done. Okay, physical trading is you go to a bank, you go to a money changer, and you physically trade your currencies into other currencies. For example, you have US dollars and that were sent to you by your loved ones, and you want to exchange them for Philippine peso. You go to a bank, you go to a money changer, and that's physical trading. Same thing if you go abroad. Let's say you go to Singapore, you go to Hong Kong, and you came here from the Philippines. You have Philippine peso, and you want to exchange it for Singapore dollars because you want to go around there, you want to have a tour. So that's physical trading. Now, the second one is through brokers or through online trading. Now, this is much easier because before, back in the 1950s, 1960s, whenever people do FX trading, what they do is they do it physically. So, for example, they have like a bag of money with them and they go to the bank and have it exchanged. And then after exchanging it, they go back to their own vaults and put the money there. So it's kind of dangerous. You're welcome to do that, but there are a lot of easier ways to participate in the forex market rather than doing it physically. Okay. Now, what we can do now is we can do it through brokers. We can do online trading. Now, for online trading, what you do is you have a broker and you have a personal account with them. You open a personal account with them. Same thing with opening an account with a bank. They ask you for your IDs. They check if you're a legitimate person. And, basically that's it. And you have your own account there where you can put funds into. And the funds in there, that is the money that you can use to trade. You can use it to buy euros, sell dollars, sell a pair, buy a pair, depends on what you really want to do. So that is the money that you can use in order for you to trade. Okay. Now, what the brokers really do is that they facilitate the trades for you and they pass it on to the liquidity providers. Okay. So, for example, you want to buy Euro USD, you give the order to your broker, and your broker passes it on to the liquidity providers, which is the bigger banks. Now, the advantage of doing this is that they can give you leverage. Okay, so leverage is maybe a little difficult topic to grasp at the start, but I'll try to explain it as simple as I can. Okay, now what leverage is that the brokers let you trade more with the small amount of money that you have. Basically, what they do is they can multiply it by 2, by 5, by 10, by 50, by 100, 500, and some brokers even go as high as 1,000. So they multiply your capital by that much. They can do that with leverage. Okay? So the broker loans you money so that you can trade more. So what happens is you get to increase your trading activity. You get to increase the amount of money that you're trading in the market. So because of that, you can increase your potential profits. Okay. So for example, let's say you're trading the US dollar and the Philippine peso. Let's say last year, 2014, the rate was around, let's say 40 pesos per dollar, just for argument's sake. Okay, 40 pesos per dollar. So let's say I bought $1 last year and I hold on to it until this year. So I put out 40 pesos last year to buy $1. And right now, the current exchange rate is around 46 pesos. So if I sell my dollar back, what happens is I earn 6 pesos because of that. Okay. Now, what brokers can do is that they can increase that through leverage. What they do is they loan you money. So for example, instead of having $1, you can have, let's say, $10 to trade. Okay. So instead of getting 6 pesos from that transaction, you can get 60 pesos because you multiplied it by 10. Now, for leverage, it's also a double-edged sword. Okay? Because your potential profit increases, so does your risk. Okay? So, for example, if you multiply your potential profit by 10, your potential risk will also increase by 10. Okay? So, let's say you bought it last year for 40 pesos per dollar, and let's say this year it goes down to 39, it lost 1 peso. So instead of losing just 1 peso, you lost 10 pesos because you used leverage of times 10 and you put it to the max. Okay? So that's leverage. Okay? It's a very powerful tool. You can increase your profits, but you have to be very careful and you have to know what you're doing because it also increases your risk. Okay? So later on, it's not really leverage that we're going to manipulate in your accounts or you're going to change in your accounts. What we're going to do is the position sizing. Okay, later on I'm going to show you what position sizing is, but basically that is what we change in order to minimize the risk and control the risk in our trades. Okay. So that's online trading, and that's trading through brokers and using leverage. Now, how do we make money from the market? Okay. So making money from the market is basically what we do is we buy low and then we sell high. Okay. Now, the traditional way of earning from it is buying low and selling high, just like the example that I gave earlier. You bought it at 40 pesos per dollar and you exchange it back at 46, so you gain 6 pesos in that transaction. Okay. So that's buying low and selling high. Now, that's good for markets that are going up. Okay, so let's say 40, it goes to 46, and then you buy it again at 46, it goes to 48. So that's good in an ideal world that the markets always go up. But that's not the case. The markets go up and they go down. They go up and they go down. That's how it is. Okay. Now, what's interesting about the Forex market is that we can actually earn both ways. You can earn from prices that are going up, and you can also earn from prices that are going down. Okay, so for prices that are going down, what we do is we sell high and then we buy low. We reverse the process. It's called short selling. Okay, so at first glance, it's kind of the questions that usually arise are, okay, we get what buying low and selling high is, but how can we sell high without having it first and then buying it low afterwards? Okay, so that's kind of confusing. Okay. Now, how I usually explain it is through this analogy. Now, think that I am selling firecrackers. Okay, firecrackers. The traditional way of buying low and selling high is that I go to the source, let's say Bocaue in Bulacan. Okay, I buy a rocket for, let's say, 5 pesos, and then I go here to the metro. Let's say I go to Manila and then I sell it for 10 pesos. So that's buying low and selling high. Now, if I sell high and buy low, what I'm doing is I'm going to look for a buyer first. Okay, let's say I'm here in the metro first, and then I'm going to look for someone who's going to buy it for 10 pesos. And then when I get confirmation for that, what I say is, all right, just a minute, I'm just going to get it from the source. Okay, then I go to Bocaue, Bulacan, and then I look for a rocket that costs less than 10 pesos. So let's say I found one that costs 5 pesos. So same thing, that's called selling high and then buying low. That's short selling. And we can do that in the Forex market. You can sell high and then buy low. So this is very advantageous because we can earn from both markets that are going up and markets that are going down. So we actually like prices to move and prices to fluctuate. We like it to go down, we like it to go up, go down, and go up, because that is where we actually make money. Okay. Now, the question is, the prices move up and move down. Why do they do that? Okay. So what's the mechanism behind it? Well, the mechanism behind it is the law of supply and demand. Okay. The law of supply and demand is something that we're very familiar with. For any item that has a high demand and low supply, what happens is the item is expensive. Okay, the prices go up. Okay. And for any item that has a lot of supply, there's a lot of supply of it, and there's very low demand, the price of that item would decrease. Okay, so it's gonna go down. That's the law of supply and demand, and that also applies for our currencies. For currencies that there's lots of supply of it in the market and there's low demand, the value of that currency will go down. And vice versa. Let's say you have currencies that have low supply in the market and the demand is really high. Naturally, the price will increase. Okay, so we can observe this with the US dollar and Philippine peso. I'm not saying that this always happens, but most of the time this does. During Christmas time, during December, the value of US dollar goes down relative to the Philippine peso, and the Philippine peso goes up. Now, why is that? What happens is that there's a lot of Filipinos abroad who sends money to their loved ones here in the Philippines. And because of that, we get a lot of dollars here in the Philippines, so the supply goes up. Okay? And what we do is we sell the dollars because we don't have anything to, we can't do anything with dollars while we're here in the Philippines. We have to exchange it for Philippine peso. So what happens is that everybody is selling the US dollar and everybody's buying the Philippine peso. So the supply of the US dollar goes up in the market and the demand goes down. Now for the Philippine peso, the demand for Philippine peso goes up and the supply goes down because everybody's buying it. Okay? So what happens is that the value of the US dollar decreases relative to the Philippine peso and the value of Philippine peso increases relative to the US dollar. So my advice is, if you have loved ones abroad who are sending you dollars during December, maybe a good idea is to hold on to it, maybe until February or maybe until March, because by that time, the value of your dollars might increase. So, well, that's good advice right there.